in Las Vegas for the Internet 2.0 conference. So normally we would have normally Lee and I would be hosting this, but we got a bunch of questions for this particular mailbag episode where we felt Kelly was, we needed Kelly's expertise to deal with some of these questions. And I think you're going to enjoy this because it's something that a lot of you have brought up to us. Kelly, thank you for joining us today. It's nice to see you in person, man.
Well, thank you. Good to see you over in person as opposed to one of these webinars that we're always apart.
We're always on a Zoom all the time, and it's nice to do a face-to-face and have a human interaction. Don't worry, we'll have Lee on later on in the show, but for now, Kelly, we got to talk about something kind of serious, even though we're in this very festive, fun kind of environment. A lot of our customers have been writing in, and rightfully so, and asking us about what's the status of crypto on iFlip. The ability to trade crypto manually as well as crypto smartfolios is something that we talked about as early as last year, like Q3 of last year. And even as of today, in December 2022, it's still not available to our customers. And people have a right to know why.
Agreed.
Yeah, and so explain to us what our vision was. Remind everybody once again why we chose to take something on that was a little bit more than what like a Coinbase or a Binance would have opted to do, and bring us up to speed.
Okay, I'm going to do the best I can. I mean, the question really has one simple answer, but that simple answer has a lot of complexities behind it that have to be understood as well for the delay of our product to be able to offer crypto directly onto the platform. Fundamentally, if you're in a regulated space, which we are, we're a software company in a regulated space. Regulated means people like the groups and regulators like the SEC or FINRA have eyes on all of our products. Any person that has a brokerage account, FINRA has a mandate to be able to make sure that the companies that have their accounts are up to speed, following regulations, and so forth. I think everybody understands that. In order to offer crypto, Aaron, on our platform, the best way for us to do it is to make sure that we satisfy both our customers and the regulators.
Right.
So we knew early on when we were offering the product, we had to build our crypto access into our platform in such a way that it would allow people that have accounts, whether they were IRAs or individual accounts, so they could take their money out of their account and literally buy a cryptocurrency from the money that is in their investment account. So in order to do that, you need to work with certain kinds of entities that allow that. One of those entities is a company called Paxos. Paxos is the largest company that offers crypto inside of a regulated space. For example, Interactive Brokers uses them, and they're a $500 billion asset firm. They are literally the largest broker-dealer in the world, and they went to Paxos to get it. Everybody knows Interactive Brokers. They're a company that has a great deal of assets, and they also have a great deal of customers, and they are also the hardest company in the world to open an account. So the good news is that they have the ability to trade crypto on their platform, and they got to Paxos, made their deal with them, and opened up accounts, and now people are able to trade. However, for us, because we're a software company inside of a regulated space, the scrutiny was even greater. We were given all kinds of worms and fuzzies that the account would be opened, etc. And we built our code all the way around Paxos.
Yeah.
At the end of the day, however, the regulators looked at the broker-dealer side, the clearing broker-dealer side, and found that there was a lot of hurdles that we had that we weren't aware of, and neither was our clearing broker. One of those hurdles, of course, was to satisfy on an asset level that we would be able to offer the product. At the end of the day, the regulators created a great deal of delays and holdups for us. We were answering questions. There was so much back and forth. Our code had already been written with the understanding of it. And then even before what we saw earlier this year is the implosion of crypto, we found out that the Paxoses of the world weren't easily opening accounts for us, and by the way, many other companies that had requested opening of accounts. We are not the only ones in the space. That being said, our product was ready, however, Paxos wasn't. There is only one other company that could do what Paxos does, and then of course they ended up going out of business, and therefore we can't use them.
Yeah.
Finally, the funny part of it is the other way to possibly do this is with the companies like Binance or Coinbase. Problematic for our customers, and this will tie in with something else. If you go to those platforms, generally you're paying about 1% every time you get into the market, and another 1% when you get out. The volatility of crypto makes that seem reasonable, but the real people making money at Binance and Coinbase are Binance and Coinbase.
Right.
They make money no matter what. As a result of that, we went to Paxos like the larger regulated entities do, because guess what? At Paxos, you can get it at 50 basis points, which is 0.5% in, or even cheaper, and 50 basis points out or cheaper. And for our customers who use not just buy and sell on their own, but they also use our mathematical approaches, sometimes those mathematical approaches could cost 5-6% a year. Even if we were to trade in and out of the market just 3 times a year, that could be 6% of the assets of the account, and that would force us to be extremely good at what we do in order for us to have success and overcome the hurdle of commissions. Well, that became part of the issue. We needed to keep it cost efficient with using a Paxos. Paxos was starting to hold up all kinds of companies making applications because the regulators were looking closer and closer at it literally a year ago, more than a year ago. And that led to all the issues that we had of saying, even though we're ready for it, the regulator wasn't interested in our business and others, and they kept on asking more and more questions. So at the end of the day, we have to take responsibility for the fact that we built a product around a concept to be able to give our customers the best approach to using this asset class. And as a result of going at the best approach became the hurdles became higher and higher to achieve it, and our code had already been written to it,
Right.
and that created the ultimate delay.
Yeah, the best approach that we all agreed when we were initially, at the initial conception of this, we all agreed that this was the best approach, but it quickly became the most difficult approach because of all the regulations and the way that the crypto market imploded also amplified the regulator's scrutiny.
Agreed. And,
Right.
and at the end of the day, if we build something into our product, remember, Flip is based on the concept of having an efficient approach to the market, 0 commissions, using mathematical ideas instead of pontificating about the markets being going up or down. We have to offer, because the mandate of our company is to create an efficiency for our customers that they can't get somewhere else, or it becomes difficult to get somewhere else. And we have to hold our own mandate, which is to uphold our best interest for you, the Flip customer, and any potential Flip customer. Our best interests are in your best interest to keep costs low.
So I have a question for you then, Kelly. If the costs made sense for Coinbase and Binance, looking back, obviously hindsight being 2020, should we have gone with a Coinbase option or a Binance option?
I think not.
Yeah. Okay. Me
I
neither.
think not. I think if we had gone to it, we would have had other issues. The other issues are, with Coinbase and Binance, the money can't come out of your brokerage accounts, which means that now we have to set up new accounts that are linked out of a brokerage account. So, for example, in order to do it, we would have to be able to write software that would open up for the individual when you open up an account with us, if the person wants to trade crypto, they would also have to open up a crypto account with Binance. Now, we could have done that, or Coinbase. We could have done that. However, the difference there is the money, when you make a trade in one of these products, or we were to make a trade algorithmically for our clients on this behalf, would mean that the money would actually come out of your brokerage account, go to a non-regulated account that is done by, for example, us, or even if you initiate it on our platform. Now you're taking money out of an unregulated account, a regulated account, putting it into a unregulated account, and that becomes very problematic for a lot of the users on our platform, especially if they have custodial accounts.
Right.
You can't move money from a custodial account easily, unless you're in a self-directed IRA, into an account that is no longer a regulated account. That became a problem, which means we could have done it for individual accounts, but not people with IRAs, and there's a huge swath of our users on Flip that have custodial accounts. That became difficult.
I want to pause there for just a moment, because when you say custodial accounts and IRA accounts, that affects us in other ways too. As for stocks, for example, that is one of the things that is prohibitive of us going short. Some of our users wrote in and said, hey, obviously hindsight is 20/20, but if we just went short the market, we could have made some money here and been profitable. But we don't do that because
there's a lot to that.
Right.
So put it this way: when I was in this industry, which was most of my life, shorting was very commonplace. If we felt inside of a bank or a fund, you guys might think of them as hedge funds. I just think of them as a fund. That going short was very much part of the industry, because there are times when certain stocks are in long-term declines. You short them, you don't buy them, and so shorting is a very valuable mechanism. But I have there's two thoughts on our platform for that. The first thought is custodial accounts, IRA accounts, for example, can't go short. I can't create shorts inside of a custodial. So pardon the redundancy. The other thing is that when you think of what a short position is, you're actually borrowing money to be able to go short. And that means that there's actually a charge for that. There's an interest rate charge to that. I don't think anybody would mind that if we could make money on it. But that becomes an issue again with custodial accounts versus individual accounts, and it becomes harder to get those stocks to short if it was an individual account inside of the brokerage firm. So there's that one issue. There's also another issue, which is we could use, for example, instead of shorting, a reverse ETF.
Mm-hmm.
But I think I've explained at other times that reverse ETFs have a huge problem. It's called decay, which means funds that are designed to go, ETFs that are designed to go short, always have a decay of value every year, which means they asymptote towards zero. Bottom line is they're only useful if I'm short for a few days or a week or more. Anything more than that will always lose on those trades. We have to stay away from that. I would recommend to no one to use those kind of products unless they're extremely savvy and are using them intraday to be able to initiate a short. Finally, I'm going to go to probably the most powerful argument. The most powerful argument is, if you look historically at the S&P 500 or the Dow Jones, you will find that of all the months going back historically, 70 years or more, back literally to the 1950s, after World War II, if you were to take all those years, say 72 years, multiply that by 12 months, you have a pretty large number. 85% of the months are up in the market. 15% of all the months since 1950 are down. In general, shorting doesn't work. The markets, especially indices, are designed to go higher. Again, this is something we've talked about before, but at the end of the day, the S&P 500 is an index created by Standard & Poor's. They kick things out that do poorly, and they replace them with things that do well, forcing the index to always have an ascent. And that is why we use the S&P and those kind of products extensively, because we know they're biased. So we should trade the bias. Just like we know Apple does well historically. Like it or not, it does well historically because it's innovative. Indices, though, are even more powerful because they're manipulated by their creators to be able to ascend, not to descend. Otherwise, why would we be ever interested in following an index that goes possibly down?
Yeah. You'd have no faith.
You have no faith.
People had no faith in it.
So as a reason there, why would I be interested in shorting a market that only goes down 15% of the time? I have to be very careful. I have to be very quick. In general, over the life of an investment, you're going to be long the markets. And we've decided for the best interest of our customers, the regulators, the issues of custodians, that being long is plenty good enough. You don't need to go short to beat the market. You need to be patient, and you need to just basically be long. Or the alternative is cash, which we've maintained this year.
Gotcha. And finally, we're talking about, a lot of this conversation has been kind of looking at, behind us and explaining the past. Let's look ahead to the future in 2023. And what do you think is going to happen with the crypto market? We had the implosion of Bitcoin. We had the FTX scandal. It was a very eventful kind of year. How does that impact 2023?
Greatly. Let me put it this way. I think 2023, because of the contagion that is occurring because of FTX, the contagion, as I mentioned before, and for example, some of the AI circles, is that you see one company fall, and now you're looking at everybody else in the industry. So people, for example, have a huge scrutiny on Binance and Coinbase. Those businesses, up till now, appear to have been run properly. Their stock prices, of course, have gone down. That makes absolute sense. That doesn't mean that they're fundamentally sound. Their books were run properly. There was no hanky-panky. I have greater faith in the Binances or in Coinbases. Their business models are good. The only issues they face, of course, is the underlying asset class that they use and have a platform for, which of course has gone down 70 some odd percent. And as a result of that, the companies may be strong, but their stock prices are going to go down because people are just not as interested or of making big positions in crypto in the short run, and very likely through at least 6 months, the first 6 months of 2023. So I predict, if no other contagions come out over the next, say, 3 months, through the first quarter of next year, I would predict at that time we would be more interested in the crypto markets to go get back into them if we're not already in them. For those who have crypto right now, I wouldn't sell my crypto. And if you talk to most of the people that have been asked that question on other news channels, they don't want to sell their crypto. They would sell their crypto if the market went up so they can get out at a break even.
Right.
Or some of them still are holding profits and they're long-term believers. They're not going to sell. There's a lot of people that just feel that crypto is an option at this point.
Right.
In other words, it's cheap enough to say, I don't care. Mm-hmm. If it goes to zero, I lose what I put in it. But if it goes back up to 70,000 or beyond, I'm still going to do well. It's like a non-expiring option.
Right. If you're speculating, the risk reward is a lot more friendly now than it was
then.
Yeah.
And at some level, everybody, even though this was not the intention at all, it kind of worked out well, because in general, if crypto was on the platform, and this is all luck, and this is something that we could look at in many different ways. People generally, when they go into something like crypto, they're buying it, and the product has gone from about 70,000 down to 17,000. Obviously, those people would have lost, and not only that, we wouldn't have been able to allow, again, Paxos, if we had had our approval to get the Paxos platform initiated. They don't allow the short position either inside of our regulated accounts because they're the regulated part of the industry.
So are you saying, just to be clear, even if crypto was released as scheduled back in March or April-ish, whatever it was, and we had our smart folios or the manual trading available back then, we would have likely have lost some money?
When a market goes down that much, our models were out of crypto for most of this. And by the way, we wouldn't have lost if you were in a model. I would be more concerned if people on our platform that just would have said, oh, it's available and we're going to buy it because, we all should have some crypto. It's easy to do. So our models did extremely well by just sidestepping it. Like, that's what our models are designed to do.
Right.
And by the way, heads up everybody, the models probably would not likely get long anyway, even if we had it available until, for example, probably somewhere in the second quarter at best. Because the market needs to absorb literally this move from 70,000 to 17,000. This is not a time to buy. I think most people on the other end of this that might be listening to this podcast would agree that not quite yet.
Yeah.
It's not like this market is going to go up in a hurry. However, if it stabilizes, which I suspect fully that it will, I think this could become another opportunity again. And right now, though, it's just a sleeper. It's dormant. It's in its cave. It's been tamed. And now is going to see what happens in the next, say, 3 to 6 months, of whether or not we should continue to own this and maybe start buying it again.
Gotcha. Well, Kelly, thank you so much for that update. Great to see you again in person.
Likewise.
Yes. So next up, we will have Lee joining us for a couple more questions that we got from Mailbag. Stay tuned. All right, and welcome back to our special Las Vegas edition of the iFlip Mailbag. I'm sitting here with none other than my co-host, Lee Gearhart, who just won the Internet 2.0 Outstanding Organization Award. Randy won it last time that we were here. I wasn't here for that, but Randy won it last time that we were at this event. And it is now Lee's turn to win the same award. So Lee, you just won the award. How you feeling, man?
Yeah. Hey, 2 in a row, I'll take it. But as the plaque says, it has our company name on it, not mine. So it's really more about the team that we've built around us and all the hard work everyone's putting in to make us, what we are really today. So happy to be surrounded by folks like Aaron and Kelly, Nova, Randy, etc. I'll leave some names off. I can't get everyone, but it's really about them, not about me.
Absolutely. Well, it's always a great honor to win any award. And normally on Mailbag, this is not an award show, this is a Q&A show. And we've gotten to most of your questions that you mailed in. Some of them will be reserved for the AI Circle because it's just a better fit. And with all those questions out of the way, we did get some interesting ones during your presentation towards the end in the Q&A segment. And so I wrote some of them down because we weren't able to broadcast that live.
Sure.
You're not allowed to do that. So I wrote some of them down, and if we could go over them again. Is that cool?
Okay. Happy to.
So the first one is, why is iFlip a good fit for someone with no stock experience whatsoever?
Yeah, so if you don't have experience, typically, and even people that do, oftentimes people invest just by giving money to an advisor or their financial planner or someone like that. And they're very hands-off with it, which is fine because that doesn't add anything to their plate. What they don't get is the technology, the AI side that we can kind of provide. So if they want to be more in control, oftentimes they learn how to trade themselves, but that takes a lot of time to understand and learn, what should I be looking to buy? When should I buy it? When should I sell it? That sort of stuff. We're kind of the combination of the two where it's really a low barrier to entry because you don't have to learn about the stock market and be extremely proficient with it, but you still get to be very hands-off because the AI is doing pretty much everything for you.
Yeah, absolutely. And I'll just add to that if you have no experience, even if you have no experience, you've probably heard some buzzwords like compounding interest, right? I think it was Albert Einstein or somebody who said, compounding is the eighth wonder of the world or something like that. It's one of those forces that cannot be underestimated. And you want that kind of effect on your investment. And the problem with buying and holding is you compound your gains over time, but you also compound your losses if you're absorbing all of the damage that a market like 2022 is giving you, or 2020, or 2018. There's been many market crashes over the past couple of decades, and if you're absorbing all that damage, you're compounding losses in addition to the gains. So at iFlip, we thought, well, what if AI could help you compound your gains, but not your losses, by making it a flat zero. Don't participate in the losses to the best of your ability, or the AI's ability, I should say. Another buzzword that you may have heard of, or buzz phrase, I should say, in this case, is you can't time the market, right? So stay in. That's kind of the common catchphrase for traditional financial advisors, and there's a lot of truth to that. But I would qualify that by saying, if you have no experience, timing the market is going to be very difficult for you as a person, because it takes a tremendous amount of discipline, and not everybody's cut out for that game. It's kind of like a sport, right? Not everybody's cut out to be a professional NFL football player or a basketball player. However, timing the market isn't that difficult for a computer, for an AI model that never gets emotional, never gets tired, or anything like that. So we use that to our advantage so that you can have a passive investing experience, again with the compound gains, but not compounded losses. So it really is kind of the best fit, even if you have experience. I'm a trader myself. I have good days, I have bad days, and I still think iFlip is the best investment vehicle.
You don't have to spend your time on it. That's what I love.
That's why I don't have to do anything. I just park my money and let the AI do its thing.
Absolutely.
Yeah. Okay, so with that question out of the way, our next question is, it's related to that. Our next question is, how often does the AI trade?
Yeah, so I'll start by saying it's typically about 3 times a year per stock. So three buys, 3 sells. So, and to give some more clarity to it, technically, like, we have an S&P 500 portfolio that only has the SPY in it. So we've traded that 4 times this year, 4 in, 4 out. Every other portfolio has at least 2 different stocks, if you will, in it. Sometimes it's an ETF, like the SPY Plus. And then on the other side of it, the portfolio that has the most holdings in it is the Mod Plus with 13. So if we trade a stock about 3 times a year, that's somewhere between 6 and just under 40 trades in a year. And it obviously depends how many portfolios you're using and things like that, but it's by no means a high frequently trading system. It just wants to get you in when the math says it's a favorable time to do so.
Yeah, and we actually had somebody approach our booth over here with the same question. I guess he was somewhat of an avid options trader, and he said, "Oh, AI must have, like, how many trades are you doing per day?" Like, he immediately assumed that it was trading intraday multiple times. And I said, "No, we don't do that. Our AI doesn't even look at a bar less than a daily bar. We don't look at any kind of hourly or minute kind of bars at all, because we could. The AI is perfectly capable of that, but the more transactions that you do, the higher the computing needs are, the higher the cost, the higher the overhead, and we would have to charge the customer more. So if anything, we keep, and I should also add, at the end of the year, the results are very similar. So if we're all about efficiency, doesn't it make more sense to do fewer trades to achieve pretty much the same result than to do more trades?
Absolutely.
And then pass those savings on to the customer. That's why iFlip is able to keep the costs far lower than the typical AUM model that you see out there.
No, by the way, it's commission-free trading.
It's commission-free trading. Right.
We don't charge trade fees. Whenever the AI goes in or out, you're not exposed to that cost, if you will.
Right. And our subscription is purely for the AI management, right?
Exactly.
There's no actual fees to get in and out of a trade.
Yep.
Right. Awesome. Okay, so our last question was, how is the tax reporting done? How is that handled on our platform?
Yeah. Everyone loves them, right?
Yeah, death and taxes.
Love paying them.
Yeah.
The short answer is it's the same as everywhere else. Anywhere else that, any other investment platform or broker dealer that you might use, same thing is there. It's all supplied by Velox, who's our clearing firm. So at the end of the year, you'll get your end of the year statements. Now, I'll only qualify with if you have an IRA or something like that, where the cost basis is irrelevant. there is no taxes to report there.
Right.
And actually, just because it's about to be that time, I'll bring up that a lot of the companies that pay dividends, like I'm thinking of Energy Transfer. I keep getting stuff in the mail every once in a while from them. They'll still send these tax documents, and we oftentimes get questions like, "Hey, is there any tax to be paid on this?
What am I supposed to do with this?"
Yeah, the answer is no, but I think they're just obligated based on how they're structured as a business to send that to their shareholders, if you will.
Yeah, absolutely. I get that all the time. It's good information for you to get educated, but it's not anything that's required for you to do in terms of taxes, or it's going to affect your performance or your investment or anything like that at all. It's more just supplemental information. Is that right?
Absolutely.
Okay. Awesome. Well, that's it for this episode of Mailbag. As always, if you like this content, please like and subscribe. Hit that notification bell so you don't miss us on the next episode. Our next show is going to be next week with Kelly back with another episode of the AI Circle. So stay tuned from the next